Imagine trading a simple pattern for the past 30 years on hundreds of stocks and getting this equity curve. This is not an overfit equity curve. In fact, the pattern is so simple, it is very, very robust. I did a video on this pattern, which is called a pullback pattern, testing futures and a portfolio of ETFs, including gold, commodities, country ETFs, and of course, the US stock indexes. You can watch that video over here. The pattern is extremely simple, where we are waiting for a pullback, then we buy it and we exit when it makes a higher high. Now, there is nothing new so far because this pattern existed for the longest time. I mean, it's a mean reversion strategy on the US indexes. And in any trading platform, you can change the S&P 500 symbol and put Apple or Google or Microsoft or whatever stock you like. The robustness comes from trading hundreds of stock at the same time. The problem is there is not enough capital to trade all these stocks. Of course, unless you are a hedge fund, then it's totally okay. And the other problem is having the platform to test a portfolio of stocks using a single pattern. Now, in the retail space, there is not enough. There are two platforms that can test portfolios of stocks or multiple symbols. But even then, they are not connected. So you still have to find a way to automate the trading of those symbols into your broker. Fortunately, recently, StrategyQuant X developed this platform where you can test your strategy on a portfolio of stocks or any portfolio you create, and then take those signals directly to the broker. So there is no middleman. So how can we apply this simple pattern with hundreds of stocks with a small capital? The only way to do it is by something called ranking. If you rank your symbols on some function and then you pick the top number, let's say the top 5, top 10, top 3, whatever, then your small capital can trade those symbols. So let's see how we can build this strategy. So if we go to Algo Wizard, remember this is version 137. So this is the development version, and this is the new Algo Wizard. And if you build a new strategy, now you have the option of stock picker strategy. So let's do that. So let's build the pattern first. The pattern is extremely easy, like we mentioned. So this is the pattern. It's extremely simple. We're looking when the low is lower than the past three lows. So we're looking at 3 bars, and if current low is lower than that, then we will go long. And we will exit when the high is higher than the 3 bars. Now, because of the stocks has a drift to the upside, just like the index, then we can go longer. So this is our pattern from the previous video, where we go long when it's low and we exit when the high is high. Now, remember also from the previous video, we already had the filter of 200-day moving average. And this is our strategy. Because we picked this on stocks, we have now stock groups. So you can see we don't have the symbols for futures and currencies and single stocks. We only have group of stocks. So these groups are already built in, and you can build your own. So I will use the most popular S&P 500 index. Now the S&P 500 index contain 500 symbols, but there are symbols that goes in and out during time. So now if I go to data manager and I show you, so you can see the S&P 500 has over its history 1241 stocks that went in and out. So it's always 500 symbols, but there are many stocks that go into the index and gets out. And now with this engine, when we test back in history, in fact, it's looking at if the stock was in the index or not. So it doesn't look at the stock component today. It looks at the stock in previous history, which is called survival bias. So that's really, really good. Okay, so we're looking at the S&P 500. We have data since 1980. And in money management, we have $15,000 to start with, and we're using all the money to trade. So now if I run a full back test, we get an error because currently we are trading 500 symbols. Of course, first of all, we don't have the capital for it, but the engine is designed to rank before placing an order. Now you can trade the 500 by ranking all of them. So first we need to rank the position. So I'll try to explain the ranking with this chart. We are buying when today's low is lower than the previous 3 bars. So it's daily bar, so we're looking at today lower than previous 3 days. We will exit when the high is higher than the previous 6 highs. Now these arrows point to a pullback pattern. Of course we have so many, but I picked these to show the ranking. At the bottom here, I have the ROC. This is the rate of change. So this measures the rate that the close changed from the previous close. And this first pattern, it's true. This is a pullback. And the rate of change here is for minus 4.6. This is lower than this one. And it's also true. It's a pullback pattern. But the rate of change now is minus 6.27. This is also true. It's a pullback pattern, and current low, this one is lower than all these. But the rate of change is minus 206. And this one is a pullback pattern. This low is higher than this, but the rate of change is minus 253. So the rate of change here is lower than this one. What I'm trying to say is not all pullback patterns are the same. This will be the lowest. The second one will be this. Third one will be this. And fourth one will be this. So this will be ranked the last, even though the price is the lowest in this chart. And that's the advantage of ranking. Of course, you can have million variations on ranking. We are using rate of change right now because we are measuring pullback. So anything that measure pullback will be beneficial in this strategy. So if we go to position score, here we can decide on the ranking function and the number of positions. So typically you want to trade between 3 and 10 symbols. Of course, this will depend on the capital you have. So I will go with 5 in the middle. And here we will calculate the position score. So I use the rate of change for 5 bars. 5 bars sits in between. I mean, we can pick any 3, 4, 5, or 6. But 5 gives us the best result in terms of ranking. Now, why did I add 1 minus? Because ranking picking the highest number. So remember, we want to measure the lowest. So if we do 1 minus, we will flip basically this curve. Okay, go back to our long position. We're entering with a market order, no stop loss, no nothing. So we're just exiting when we are hitting the high. So let's run a full back test. First problem is connected to SQX. As you see, the number is, this is exponent 9. That means there are 9 zeros. And the reason is the position sizing. So if I show you this, if we start, this is 1990. You can see we are starting with $15,000. Position sizing is very normal, 41 shares, 427 of $7 shares. But if I go all the way down, you can see now I'm trading 4,155,000 shares. So unless you are a hedge fund, then this is not doable. So currently the only way to limit this is with a shorter date. So let's limit this to 2005-01. Okay, so this should make sense now. And we can see now we are trading 2,000 shares. Okay, so that's very acceptable. 4,000 shares of 41, 1,000, 1,000. This is very acceptable. So let's add a stop loss of 25%. So 25 is good. Remember, we are trading 5. So this 25 divided by 5 will be 5% on our capital. So let's run. So this is now very, very reasonable because we have a stop loss, and let's see if we have, and you can see here, this is stop loss, stop loss, stop. So the stop loss is working and we are losing 25% at the time. And this is very, very acceptable. Now, another thing comes is the open price. So because of course, the splits and other factors, you can see we have a very low price of stocks, and we don't know if there is enough volume to trade these stocks. Also, these will be very volatile. So in order to control this, we need to limit the price of the stocks. So now I added these limitations. So the close is below 1,000. So basically we are not trading Amazon at $4,000 or Berkshire Hathaway at, I don't know, $1 million. And we are trading all stocks above $5. Also, we want the average volume of the past month, 30 bars, which is more than a month, to be more than 250,000 shares. This is something new probably for all of you watching this channel because we usually don't trade stocks, but this is an extremely good filter. You need to filter stocks that are liquid, and you need to filter stocks that are not microcap, which is usually below $5. Because microcap, usually they have a lot of short squeezes happen, and also usually they are very volatile, which is good. It depends on what strategy you're developing. But in this strategy, we don't want that. So that's why we're limiting the price between 5 and 1,000 and the volume to 250,000 shares on average for the past 30 bars. So this will make the stock very liquid. Of course, if you have huge capital, you need to increase this liquidation. But again, you are not a hedge fund, so you don't need to worry about that. Okay, now if we test, so we stayed with the same parameters. So we're making 19% compound annual growth rate, and we're still losing above 50% drawdown. So the drawdown didn't come from trading illiquid stocks. So let's see what else can we dig through. So of course, this is the stats. It's above 60%, which is normal for mean reversion. And our open drawdown is 54%. On average, we're making $155, very good for stocks. And of course, we have a position sizing happening because we are trading 20% of our capital for every single stock because we are maximizing 5 positions. But this is something we can use. Look at this. The average number of bars in a trade is around 10. So if we add the exit after number of bars, let's add 10. Remember, this doesn't happen in 10. Sometimes it happens. I mean, we can check. Average number of bars in wins 7.9, in losses 15. So it's not the same, but the average is 10, and 10 is a good start to test. So let's see if 10 make a difference. So it did make a difference. I mean, we went from 54 to 51, but also we increased our compound annual growth rate. So this is really good. I'm going to keep this. And finally, also, there is a profit target because we might sometimes hit the profit target before reaching all these bars, and then we can go down. So a reasonable, now this is stocks, of course, you don't do this with futures. So I will put here 15% because single stocks can actually do more, can do 30. So let's do 15 and test. Okay, so we are going in the right direction. So we increased our compound annual growth rate and we reduced the drawdown. The drawdown is still 45%. I mean, it's still high, but currently this strategy already amazing. Now, why the strategy is amazing? Because we are starting in 2005. That means we have 6 and 7 going up, 2008 crashing, beginning of 2009 crashing, bull market 2009 till 2015, another crash, 2020, another crash, 2022, another crash. And so the strategy is seeing everything. We are trading multiple symbols, 500 symbols. We are ranking them while they are in the index and out of the index. So robustness, in terms of robustness, we are doing really, really well. And if we are comparing to the S&P 500 index, which is that's what we are trading, the S&P 500 index returned 14% compound annual growth rate. So we are making almost double the returns. And lower drawdown because the S&P 500 had a 57% drawdown in that period. It's excellent. Yes, we're doing really well. But 45% is really, really high. So we need to work on that. And of course, we're going to have to sacrifice some return. So the only thing I can think of is to limit the number of trades and focus on quality trades. So first thing we can do is maybe we can increase the minimum. So if we look for 4 bars instead of 3, let's see if that makes a difference. So currently we have 3,000 plus trades and we did a little bit. I mean, it was 111, now it's 30. So that's not significant. Let's look for longer. Let's go for 6. Again, we didn't decrease the number of trades that much. Remember, because we're trading 500 symbols, so we are bound to find something. So let's go back. Let me go back to 3. So 3011. Let me introduce now something new. So let's imagine this pattern happen. What we can do is that today is lower than the previous 3 days, but also we can buy next bar not on market, but we buy lower than this close. So think about it. Let's say you bought Microsoft at $100. Tomorrow is a down day. The next day is a down day. Third day is a down day. Well, now, of course, you are not comfortable at all. You're not panicking, but you're not comfortable. But what if the open next day is a gap down? Now you're panicking. Now you're going to sell. You're going to exit. And that's when we, the smart traders, will get in. So we want to get in when everybody else is just unloading their stocks. So we can achieve that by putting a limit order below yesterday's low, yesterday close, whatever value you pick. So here is what I will do. So instead of market, we will go with limit, and we have to change this default. So we will look for the close lower than an ATR, and let me shorten this. So 10-day ATR, it will be sensitive to the changes in the price. We are just deducting one ATR from previous close. So this is where the trigger happens. The next day we have a limit order below this close by an amount of 1 ATR, and the ATR is over 10 bars. And let's test now. Okay, so this is very tolerable now. We are making almost 20% and losing almost 30%. And this happened because now we took almost half the trades out. So it's like basically we're focusing on only the quality setups. So if we click on this, you can see now we're making 260 on average, extremely good. We lower the percent of number of bars we are in the trade, because now the setup is so good that we are quickly hitting our target. 20% compound annual growth rate with 30% open drawdown. And if we look at the list of trades, this is the position sizing. Again, we are totally within limit. Look at this. It's 300, 1,200 shares of 57 price. So all is very, very good. Equity chart, we're doing really, really well. The drawdown happened in COVID, and of course we can add conditions to mitigate those kind of shocks, but I don't want to do it because, you know, it's normal part of trading. So if you can handle this shock, and if you can handle 2022, so what? Look at this, we're still making new highs. So I'd rather keep everything the same. So to me, it doesn't get any better than this, because this type of strategy, it's like a portfolio on its own. Of course, again, I don't advocate to trade a single strategy, but this type of strategy where you are trading more than 100 symbols, so it's like a portfolio on its own. But of course, because they're all stocks, I mean, in crisis, they will correlate to one. And just like you saw in the equity curve in 2020, they all went down, because that's what they do. Stocks, they tend to go to correlation 1, regardless of their industry sector, when crises happen. But overall, this is a one strategy that's really good to add to your portfolio of strategies. And in my Algo Trading Masterclass version 2, I will have a single module dedicated only to this engine. So you can build these types of strategies and add it to your portfolio of strategies. Now, to show you the resilience of this pattern, we will test it on different universes. So let's go with Nasdaq 100. Now, I will not change anything. So let's keep the date to 2005. So because of position sizing, and we will keep every single thing the same. And we will run, and it's doing 20%, 33. So it's very close to the performance of the S&P 500, except now 2022 didn't do well. Let's go now to Russell 2000, and this is totally different profile. Also, the drawdown and compound annual growth rate, it's totally different. This is the S&P 1500. So that's 1500 stocks. But again, we're only trading 5 symbols maximum. And again, this one is totally different. This is the S&P 100. And this is correlated with the S&P 500, but it has a much better drawdown. This is the Russell 1000. And Russell 1000, look at this, making 25 compound annual growth rate with 26% drawdown. So that is the best so far. So you can see how you can combine multiple portfolios into one. So let's assume you have $25,000. Instead of trading a single strategy on futures or currencies or whatever, now you can trade 5 portfolios, and each portfolio trading hundreds of stocks. So you can combine, let's say, the Russell 2000 with the S&P 100, with Nasdaq Biotech, with the Dow Jones. You can combine all these indexes into, and you give each universe $5,000. So you have 5 universes, different equity curves. So they smooth the total equity curve, and you can ride those bumps in like 2020 and 2008. And the icing on the cake is this can all be automated through the new engine of StrategyQuant X. This will be connected to the cloud, to interactive brokers or other brokers as they come along. The advantage of that is it's already running in the cloud. You don't need to do anything. You don't need to rent a VPS or your server at home. So it will solve a lot of problems. Of course, it's currently still in development, but it's coming along. It's their target to achieve this, and I'm very excited. To learn more, make sure to watch these videos, and I will see you there.